The overwhelming majority of retail traders fail in the financial markets because they analyze price action in only two dimensions: price and time. They watch a large green candle expand on their screen and impulsively assume buyers are in total control, or they see an aggressive red candle and panic, believing heavy selling is underway. However, this approach is fundamentally flawed because it relies on reacting to effects while completely ignoring the underlying cause. Most technical indicators cluttering modern trading screens are merely lagged mathematical derivatives of historical price data. Price itself can easily be manipulated by algorithmic liquidity grabs, stop hunts, and short-term order spoofing. But within the core architecture of auction market theory, there is one metric that institutional market makers, the smart money, cannot hide: volume. This script provides an in-depth breakdown of volume mechanics designed to strip away the motivational fluff and focus strictly on institutional order flow. We will systematically cover a three-part framework. First, the true mechanical relationship between price and volume. Second, Richard Wyckoff's foundational mental model of effort versus result. And third, the precise identification of institutional footprints, including stopping volume, the buying climax, and volume divergence. By grounding your execution in Japanese discipline, the concept of Kaizen and systematic process refinement, you can permanently eliminate amateur trading habits and align your strategy with true market mechanics. Phase 1. Price versus volume mechanics. To master volume analysis, you must first eliminate a pervasive misconception. Price is not the market. Price is simply an advertising mechanism designed to facilitate trade. It tells you where transactions are currently taking place, but it provides zero context regarding conviction. Volume, on the other hand, is the underlying transaction engine. It reveals exactly how much capital, energy, and liquidity were expended to move price to a specific structural level. Consider the analogy of a heavy vehicle traveling uphill. Price acts as the speedometer showing a current speed of 80 miles per hour, while volume represents the engine's RPM and fuel consumption required to maintain that velocity. If the vehicle is climbing a steep incline at 80 miles per hour with the engine working at peak efficiency, the movement is healthy and sustainable. However, if the driver floors the accelerator pedal to maximum capacity, yet the speedometer drops from 80 down to 40 miles per hour, you immediately recognize that the internal engine is failing. In financial trading, when volume surges dramatically, but price fails to expand proportionately, it indicates that the market engine is stalling beneath the surface. Let us examine a real-world case study within the U.S. equity markets using the S&P 500 ETF, SPY. Imagine SPY pushing past a major 6-month structural resistance level at the $500 mark. Uninformed retail traders observe a bold, bullish candle closing cleanly above resistance. Standard trading literature instructs them to buy the breakout immediately, leading to a wave of market buy orders. However, a deeper institutional audit of the volume panel reveals that the breakout candle printed on volume 35% below its 20-day moving average. This data point is a critical warning. Major institutions like hedge funds and investment banks move billions of dollars. They cannot build significant positions on thin, below-average volume. Therefore, a price move past resistance on low volume is not a genuine breakout. It is an illiquid void. Smart money quietly allows price to float upward into thin liquidity to lure retail breakout traders and hunt resting stop losses clustered above the swing high. Once that retail liquidity is trapped, institutions flood the market with heavy supply, driving price aggressively back below resistance. A price breakout without institutional volume validation is nothing more than an unbacked advertisement that no major player intends to defend. Phase 2. The mental model, effort versus result. In the early 20th century, legendary market technician Richard D. Wyckoff formulated a mental model known as the law of effort versus result, which remains the cornerstone of modern volume spread analysis. In this structural model, effort is quantified by volume, representing the total number of contracts or shares exchanged during a given period. Result is quantified by the price spread, representing the physical distance between the high and low of a candle or the width of its body. In a healthy, harmonious market, effort and result must maintain a logical ratio. High effort, represented by a massive volume spike, should naturally produce a large result, a wide-range candle body. Conversely, low effort, represented by minimal volume, should yield a small result, a narrow-range candle body. When effort and result are aligned, the prevailing trend is considered structurally sound. However, your primary competitive edge as a trader emerges when there is a distinct disharmony or anomaly between effort and result. To illustrate this anomaly, consider an intraday case study on a 15-minute chart of Apple, AAPL, or Tesla, TSLA. Suppose price rallies aggressively into a major historical supply zone or previous all-time high. At that key structural level, a 15-minute candle forms, generating the highest volume spike of the entire trading session. Say, over 6 million shares exchanged. This represents extraordinary effort. Yet, when analyzing the physical candle itself, the real body is extremely narrow, resembling a doji, or a tiny spinning top with wicks on both sides. This represents minimal result. The critical analytical question you must ask is, if buyers expended 6 million shares of effort, why did price fail to expand upward? The answer lies in institutional absorption. At that exact price ceiling, smart money placed a massive wall of passive limit sell orders. As enthusiastic retail traders executed market buy orders, institutional algorithms continuously absorbed that buying pressure without allowing price to move higher. The institutions used retail demand as exit liquidity to unload their long inventory. High effort paired with zero price progression signals that supply has overwhelmed demand. Within 2 candles, price reverses and drops 4%. This is not randomness. It is the law of supply and demand playing out through order book mechanics. Phase 3. Identifying key institutional volume patterns. The third phase of volume analysis requires identifying specific institutional footprints left on the chart, starting with stopping volume. During an aggressive downtrend, panic reaches a boiling point across retail networks, triggering liquidations and cascading stop losses. On the chart, this appears as a wide-range red candle plunging downward. However, inspecting the volume panel reveals a monumental spike that eclipses previous session highs. Despite this extreme volume, price fails to close near its low. Instead, it bounces slightly and leaves a significant lower wick. This is stopping volume. Institutions are utilizing retail panic as a counterparty to step in and absorb huge blocks of shares at wholesale prices. Their massive buy orders halt the downward momentum of the trend. When extreme volume appears alongside a prominent lower wick following an extended decline, it signals that institutional demand has entered the market, and the downtrend is near immediate exhaustion. The second crucial footprint is the buying climax, which typically develops at the absolute peak of a parabolic bull run. When positive news hits mainstream headlines, retail FOMO reaches its peak, driving impulsive buying from late retail participants. The chart prints an oversized, wide-range green candle accompanied by historic volume. While retail traders view this as confirmation that the asset is going higher, it actually represents the final distribution phase by smart money. Institutions exploit this massive wave of retail buy orders to offload their remaining long positions at peak valuations. When an extraordinarily high volume spike appears after an extended, mature uptrend. It rarely indicates trend continuation. It is a classic liquidity transfer, marking an impending market top. The third footprint is volume divergence, a powerful signal of structural weakness. Consider a scenario where the Nasdaq 100 or S&P 500 pushes up to print a new higher high on the daily time frame. However, comparing the volume bar of this new peak to the volume bar of the previous peak shows a clear lower high on the volume histogram. Price is advertising strength by pushing into uncharted territory, but volume is revealing that institutional participation is actively declining. This divergence proves that buying pressure is drying up and the rally is moving forward purely on short-covering momentum rather than fresh institutional capital. Unbacked by institutional volume, trends exhibiting this form of divergence are extremely vulnerable to sharp, high-velocity reversals. The Japanese execution framework and conclusion. Understanding these analytical concepts on paper is straightforward, but applying them consistently under real market conditions requires a systematic mindset based on Kaizen, the Japanese philosophy of continuous, process-driven refinement, and absolute emotional detachment. Destructive trading habits, such as chasing breakout candles, taking entries without volume validation, or engaging in emotional revenge trading, occur when market participants treat price action like a casino rather than an auction order book. To permanently eliminate these flaws, you must integrate a strict three-step execution protocol into your routine. First, never take a breakout trade without volume confirmation. If breakout volume is running below the moving average, immediately invalidate the setup. Second, search for effort versus result anomalies, exclusively at key structural levels, as volume spikes occurring in the middle of consolidation zones represent meaningless market noise. Third, always wait for the candle close before executing a trade. Intraday volume accumulates over time, and evaluating effort within an open, unclosed candle leads to false conclusions. Price action illustrates what the market is doing, but volume reveals who is driving the move and how much conviction sits behind it. Strip away redundant, laggy indicators and refocus your approach entirely on the raw mechanics of auction market theory. Conduct a thorough audit of your last 20 trades, analyzing the volume profile of your entry candles to identify how often you bought into low-volume traps or buying climaxes. Objective market data does not lie. When you trade strictly based on institutional order flow and effort versus result mechanics, you eliminate emotional bias and establish an institutional edge in the markets.